Welcome to Wider View, the program that provides perspectives on the news outside the narrow confines of the mainstream media. I'm your host, Charles Dunaway. I'd originally asked Mike Whitney to come back to discuss several of his recent articles on the Federal Reserve Bank's activities over the last several years, but the stock market downturn over the last several days seemed like the best place to start. Welcome back, Mike. We're talking on Thursday, the 27th, and as of now, it looks like the stock market is at a record loss today, right? And is down almost 3,000 points for the week. And this is being seen as a major crisis. What's your take on this crisis and, where we are and how we got here?
First of all, a little background. Today's loss of 1,190 points was the latest, the biggest point drop in Dow Jones history, and that includes the Great Depression.
Wow.
At the same time, the 10-year benchmark Treasury, which is a financial asset, which all other assets basically are correlated and valued in relation to the 10-year, that dropped to its lowest yield in history as well. It's all-time record of 1.26. And what that tells you is if you can borrow money from the government, if the banks can, at 1.26, which is just a penny and just 1.26, then actually what that is forecasting is that there's absolutely no inflation on the horizon, and that growth is basically looking very dim for the foreseeable future. It's a very, portentous kind of ominous look into the future, and bondholders, of course, represent twice as many investors than the stock market. So it's an important milestone indicating that the future growth in the global economy is likely to be very slow, and stagnation is essentially spreading across the country. So aside from those like beacons that, those red lights flashing in the market, we had this terrible loss today, which was the sixth consecutive drubbing in a row. And there were moments when there were rallies within the downdraft,
Right.
The prevailing downdraft, but those were quickly overtaken by the general pessimism. And it's not just the economic situation, it's the financial situation where the fundamentals are deteriorating as well, as far as corporate earnings and revenues and just things of that nature. The situation is looking pretty bleak. And the people who feel as though in past incidents, the Fed has come in and either slashed rates dramatically or added liquidity through quantitative easing and these different programs it has, where it's made extraordinary accommodative policy, are still believing that the Fed can come in and do something quite dramatic and maybe put a floor under these falling stocks. But I kind of disagree with that, and a number of writers, which I cited in this last article, agree with me that this is something different than the Fed has had to deal with before. When you think about it, and this is just a real simple explanation of how interest rate cuts work, when you reduce the cost of money, more people borrow money. That's the whole theory. You reduce the cost of money, you make it more attractive for people to borrow. Well, what happens when people or businesses borrow? They spend the money. They spend the money in the real economy, and that creates more employment, more activity, and more growth. When you have a situation like we have today, where the problem is not on what they call the demand side, it's not a matter of spending, it's a matter that the supply chains have been broken, seriously disrupted. Like if you are selling computers in the United States and you get your components from China, and China has shut down business for 3 consecutive weeks, you're not going to get those in time, so you can't sell a computer. So whether there's demand or not doesn't matter. Whether the Fed cuts rates or not, the Fed doesn't have the component to put in your computer to sell it. The last time we had a supply problem like this was in the 70s with the big oil embargo. And you know how that ended up. Not very good.
Not very good.
So the disruptions that we're having now are really quite serious. And they're increased in potency by the fact that there's this uncertainty surrounding the coronavirus and how it's spreading like wildfire. And every day it appears to be showing up in capitals across the world. And that is causing great unease among investors and institutional investors about what the ultimate impact is going to be as far as investment. You have to understand that the way institutional investors invest and the way the average mom and pop investor invests is much the same in one respect. You are allocating capital with the expectation that you're going to get more of a return when you invest it. Okay? Mm-hmm. If the future becomes cloudy and uncertain, as it is today, and you really don't have any expectations of what that outcome will be, then people hunker down and take chits off the table. They remove their money from the market, which is what's happening now. It is the uncertainty that is driving this market lower and lower because people just have nothing to compare the impact of this coronavirus on the economies around the world, and on the markets. So they're just saying, I quit, I'm getting out. Mm-hmm. And this hasn't quite sunk in yet. People haven't really grasped this entirely yet, because as people have grasped it, the selling of stocks the sell-off is accelerating. And the reason they haven't grasped it is because for the last 7 years, people have been anesthetized, basically put to sleep by the constant interventions of the Fed to the point where it's changed their behavior dramatically, the way people used to invest and the way they invest now. They used to invest in relation to PE ratios, profits, earnings, and, basically just the fundamentals of the company. Now they look at the economy is looking sour, so they're expecting more easing of policy from the Fed, so they buy more stocks. Or the economy is looking good, so they go out and buy stocks even more. So no matter which way the economy goes, the economy is what they say decoupled from the financial system, because the Fed has retrained everyone to behave like the Pavlovian dog. Whenever they can anticipate more support from the Fed, they buy more stocks. Now we're going back to fundamentals, which is causing this shock and this reconnection with the fundamentals between the stocks and what their underlying true value is.
Yeah, the last big crisis that we had, the 07-08 crisis, was basically a debt-driven crisis. We had investment banks, basically inventing these credit default swaps and other arcane instruments, because they were highly leveraged. And, they were just depending on things to keep getting higher and higher and to keep bidding up higher and higher in terms of home prices and so forth. And that once that stopped happening, everything collapsed. I can understand why the Fed could intervene there in terms of interest rates, in terms of the quantitative easing business, and help that out. But
can I interrupt? Yeah. Can I interrupt you for 1 minute?
Mm-hmm.
Because the point you make is not just important; it's critical, and it's pivotal to your listeners understanding what happened in the financial crisis. People have a very vague idea about subprime loans and housing and real estate, and of course mortgage-backed securities. But their vague understanding keeps them from really grasping what happened in the financial crisis. And you put your finger on it. And the financial crisis wasn't caused by homeowners borrowing too much money. It was caused by gigantic financial institutions borrowing too much money. And much of it was loaned to each other through repurchase agreements. Now, I know that sounds very, abstruse and opaque and everything else. But the amount of subprime loans that were defaulting was only in the amount of roughly $1.5 trillion, which sounds like a lot of money, but it wasn't enough to bring down the global financial system. The amount of mortgage-backed securities that were leveraged up, that was the maximum type borrowing on these particular vehicles, was over $10 trillion. That was enough to bring down the global financial system. And that fraud of creating those loans that were made to people they knew could not repay the debt was enough to bring down the financial system. The reason I want to bring this up is because we have to at least consider the fact that the prices that are falling now are nowhere near settling or finding a bottom. And the reason I say that, we discussed this the other day, is when the Dow Jones hit its bottom in March 9th, 2009, it was 6,500 points, okay? Mm-hmm. And when it peaked a couple of weeks ago, it was over 29,000. That's more than 4 times the original value. So where did that value come from? It didn't come from companies that are sputtering along, making decent profits, but stagnant wages, an economy that has never grown really over 2% for the last 10 years. It grew because somewhere masses of leverage, masses of debt were being created that has been increasing the value of the market. Now that the stocks are going down, that bubble is deflating very quickly and could accelerate. And so if you're an investor and you're saying, well, and this is a mistake that I think a lot of people make, well, it's gone down 10%, and I'm going to stick with it because it could go down 15 or 20%. In the last crash, it went down 58%. In the great crash of 1929, it went down 85%. So it depends on how much pain you can take, but the presumption that once we get through this, stocks are going to start climbing higher again back to where they were, I think is naive at best, because they're where they are today because massive debt has been used. And that sort of leveraging might not be possible in the future.
It seems that would have like a big effect right now on this bubble itself. You wrote a couple of articles a week or so ago about the repo market and what the Fed has been doing. And I think we all remember the quantitative easing and the $700 billion that the Treasury Secretary demanded from Congress and got, of course, in the waning days of the Bush administration. That never really stopped. According to the articles that you had written, I mean, that the Fed has kept on pumping money in to the tune of, are we talking like about 30 trillion or something like that, 25 to 30 trillion dollars?
According to Wall Street on Parade, and they have all the documentation, it was something in the neighborhood of about $26 trillion. But that was, loans and other perks. It wasn't like just cash handed over to them. But yes, it was an astronomical amount of money. And it's not just the money that is shown on the Fed's balance sheet, which is in excess of $4 trillion. But even so, I mean, think about that. $4 trillion, most of it U.S. Treasuries. No, U.S. Treasuries are very low, but when you put that much money into a particular issue, you're really pounding down interest rates pretty ferociously. So what would interest rates really be if the Fed had not meddled in the market? Well, they'd probably be 3.5%, 4%. Mm-hmm. In any event, they would be high enough so that we wouldn't have this catastrophe today because banks would not be borrowing money to fuel their stock buybacks, et cetera, and we just wouldn't have this huge bubble that has not been in the interest of working people at all. None of this is trickling down. In the last 10 years, since stocks hit their bottom in 2009, I'd say 11 years, okay, every single year, a disproportionate amount of the wealth, as you know, has been transferred to the 1%. And that is a policy decision. That is the policy. That's not a result of some random act. You could say that it was, that's just the way it turns out the first year. No, it's turned out there every consecutive year, every consecutive month, every consecutive week. The system is rigged to send the money just in one direction. And meanwhile, as you know, most of the good-paying jobs have been offshored, sent overseas or whatever. And most of the jobs that are available are service sector jobs, working restaurants, bars, whatever. But the economy is not thriving in any way. And like I think you pointed out before, something like 40% of the American working public could not withstand a $400 surprise bill from, say, like the hospital without having to borrow money. So,
No,
I mean, it's just a disaster all around.
you're right. I mean, everything is going up because it seems when you hand money to banks, investment banks, even hedge funds now, I understand, are getting some
Yes.
European central banks, all the people that the Fed has been basically funneling these trillions to, they're investors. They're going to invest in the asset that provides the highest return. And that's not going to be investing in a new fledgling industry or investing in building a new factory somewhere, or certainly not in raising wages of anybody. To some extent, why we have the high real estate prices that we do now, why the stock market is, in the 25,000 area rather than the 5,000 area. The money is just seeking the best return it can find, right?
Absolutely, absolutely. I mean, and it's such a counterproductive, suicidal policy because we were talking about Huawei, the telecommunications corporation that creates the cellular infrastructure products around the world. Well, yes, China has helped that company as far as providing state subsidies. Even so, even with that unfair advantage, Huawei is taking its revenues, its profits, and recycling into the company, creating more high-paying jobs, retraining its working staff, building new factories, extending its product around the world. I mean, it's doing a fantastic job as a competitor, while its competitors in the United States are taking their profits, buying back their own stock, not developing product, not developing R&D, not developing new, factories or plants, except in the poorest parts of the world where they can control their labor costs. It's just that Western-style capitalism has turned inward, and it's become very confiscatory and very parasitic, and it seems to be just destroying itself in front of our eyes. Mm-hmm. I think, quite honestly, that what we're seeing with this crash right now is that naively the people who run the system, and they're not really regulators any more than the FAA is regulating Boeing. We see how incestuous this is and how the industries basically run the regulators. They own the regulators. Oh, yeah. And the regulators are just a rubber stamp to, basically make it look like they're doing things appropriately.
Right.
But, it's the same thing with the Federal Reserve. But I think they created this very dangerous suicidal policy thinking that it was airtight, and they could not see where pumping more money into the system would not be an all-purpose remedy for all things. And now you can see that in this situation, more money isn't going to work. It doesn't work with supply chains. And so if the market falls far enough, fast enough, that these companies that have massive debt, basically, that they can't roll over their debt, then what? Then you have individual companies defaulting that owe other companies money that are in trouble afterwards because they're not getting their money from company A, and that tends to domino through the entire system. And that's what happened last time. We couldn't let AIG go under because if AIG went under, it would have taken about 7 or 8 banks along with it. And that's basically what's happening now. This is a daisy chain of connected companies with a policy that is just absolutely futile and suicidal.
You're talking about the investment in stock buybacks and the failure really to build the industry up. I mean, even our one big domestic industry, which is weapons and military systems, is producing planes and ships that cost far more than they were supposed to cost, but then don't work. Whereas the Russians, for example, are spending far, far less than we are, and producing innovative hypersonic weapons that can destroy our fleet before it even gets a shot off. The other thing that hits here is the negative side of globalization. I mean, there are a lot of negative sides, but one of the problems, of course, is that because so much stuff right now comes from China, there's going to be a tremendous effect. I mean, for example, most of our pharmaceuticals now come from China. I believe I saw a figure of 80% of U.S. pharmaceuticals are sourced
Mm-hmm.
in China, how much of all of our cars, our computers, our phones, all this kind of stuff is made in China. And if that slows down, particularly with the pharmaceuticals, that could be devastating for the
Oh, it's
country.
unbelievable. I saw today on the Business Channel, the CNBC, that well over 150 individual drugs are produced in China. And of course, the naive response to that is, well, that's good because we'll create jobs over here. We'll just make our drugs over here. No,
No.
that's totally naive and ridiculous. It's like this is 20 years of technology transfers, creating these pharmaceutical labs that can create this stuff. And yes, it's true that some of these, drugs are very expensive, but a great portion of them are generic drugs that are actually quite cheap, and these companies make a very small margin on them. You're not going to get that if all of a sudden you start from square one in the United States trying to pound out product and thinking, well, we'll bring the jobs back here. No longer possible. We're in a deglobalization mode right now with the tariffs and the trade wars and stuff like that. And this thing is propelling us further into that world, but it's not feasible unless the United States wants to return to the dark ages to do that. I read where nearly 40% of Chinese production is American companies operating in China. Mm-hmm. So try to eliminate that. They might have American name brands. You might think they're American, but in name only. And, try to exclude their products because of some virus from your quality of life. And you're going to see your standard of living is going down quite dramatically.
Well, and the companies, in order to build the factories and to make the products that they currently are making in China, to make them here, would require a huge investment of money by these companies, and they have no money at this point. And particularly as the stock market falls and falls, they're going to have even less money. So, they won't have anything to invest, it seems to me.
Well, I think that's the concern, and that's why in the article I mentioned Kevin Warsh, who was the former Federal Reserve governor, and he was Bernanke's right-hand man during the financial crisis. So he was there designing the first quantitative easing, the second quantitative easing, all of these various programs that basically kept the financial system limping along until they got enough money to basically establish their own independence again from the Fed. And he was saying today in the Wall Street Journal, an op-ed in the Wall Street Journal, really worth reading, that the Fed has to operate now, or has to launch a campaign right now, basically in coordination with the other central banks around the world, to have some massive program that is going to ease rates, restore confidence among investors that the Fed and the other central banks are doing whatever they can to put a floor under stocks and stop the bleeding now. And which tells me, a couple things. The most important thing it tells me is the last time we heard this kind of hysterical mantra was just prior to the meltdown of Lehman Brothers, when they're saying that you better get off the schneid right now and do this today, especially a serious person like Kevin Warsh. And I assure you, this is a serious guy. He's not a guy who runs around with his hair on fire on CNBC. He's a guy who you take seriously. And for him to say that means that he sees things or knows things that you and I are never going to know. And it tells me that in some part of the system is in great distress right now and could be in meltdown phase. And the reason I say that is because we already know about overvalued commercial real estate. We also know about corporate bonds. People have been borrowing money. Previously responsible corporations have been going out, getting money in the bond market, basically raising money from mom and pop guys like you and me who think, wow, I like Xerox. They make good products and stuff like that. They've been taking the darn money and buying their own stock. To me, it's an open deception. It's openly deceptive because when you buy a bond, you naively believe that you're buying a part of this product, this future, this product development, this mindset for making money on particular industry, and they're just essentially shoving into their pocket by putting it into an area that only inflates executive benefits.
Mm-hmm.
Then you're kind of getting ripped off. I mean, that's my own opinion on it, but I think it's a ripoff. They've been raising the red flag about corporate debt for the last 3 years, and something like this could be possibly the final domino that creates a real issue and brings down large parts of that market.
Let's explore some other avenues then, because it seems if the Fed, as you say, the Fed no longer has the proper tool available, in other words, lowering interest rates or buying more Fed treasuries or any of the other things it's been doing is not really going to alleviate this problem, then it would seem to me the only other place we have is the political system. Something like the TARP bailout or some other method of injecting something into the economy. Given the current polarity between the different parties and the fact that we're in an election year, that doesn't seem like a real likely possibility, even if there were measures that could be taken. In other words, even if there was something, for example, that the Congress could pass to do something to help. I mean, one thing I read talked about using the SOM rule that would perhaps do stimulus payments to households if the unemployment rate went too high.
This is why I think, if you were to look at the polls right now, that Bernie Sanders, if he ends up being the candidate, no matter how you cut it, this downturn right now is very much in Bernie Sanders' interest. I mean, this gets him elected, because now we have a crisis situation, and now people are looking for more extreme remedies. They're going to look beyond the traditional, conventional Democratic candidate because they're just not getting the results they need. If Bernie was sensible and really could wrap his hands around what's happening right now, he would take the opposite tact of Kevin Warsh. Kevin Warsh is basically saying, we got to do something. And by the way, what we should do is save the financial system again. Let's have another series of bailouts. What Bernie should be saying is that if you have 40% of the population that is one little crisis away from, a catastrophe from financially, those people could very well lose their apartments, lose their homes, lose their jobs, basically fall out of the middle class as this problem accelerates. People are laid off, the economy stagnates, we slip into negative growth, and there's going to be a great shakeout. And there's a lot of people. I mean, our homeless situation is already exploding, but in a downturn economy, I mean, you're going to see a real problem. And these are people, the working poor cannot really take this on the chin, because they're not going to be able to make their loans on their cars. They're not going to be able to make their house payment. They're not going to be able to pay the rent. And so we're going to see people filing out of the street and looking for government relief. And there has to be someone who anticipates this and takes the long view and says, look, we got to do something about this now.
It would help if we had a president who actually believed in government relief for people who are in trouble. It could create, for whoever the incoming president is, a situation very similar to the one that FDR faced in his first term, where the mood is that the government has to act and something has to be done, and so let's do something.
Just looking at the data points, I'm trying to imagine a scenario in which there is a sharp rebound, and I just don't see one. I think the situation seems to be accelerating rather than decreasing in speed. So the problem is, like I said before, when I mentioned how much the Dow is over quadrupled, is that we don't know how much down is. How far is down? These stocks are grossly inflated because they're totally detached from reality, and now all of a sudden, gravity has come into play, and we find out that it was kind of like all smoke and mirrors. That there are a lot of good, solid, well-managed, productive companies. I'm not disputing that. But are these companies grossly overvalued vis-a-vis the stock market? Well, yes, they are. And they are inflated to that extent because people have kept pumping money in there with the assurance that the Fed had their back and that there was never going to be any downturn. And now the Fed has hit a bump in the road that it can't fix itself. It is the realization of what's happening that is pushing the stock market down because people have not wrapped their brains around this yet. They don't, I mean, it sounds like a very simple proposition. The Fed can't fix this. But when people realize the market has only gone up because of the Fed, then they start to see the seriousness of it.
Mm-hmm. Yeah, I think that's the thing that I picked up so much from your previous articles. By the way, all of your articles can be found on the UNC Review, unc.com. Look under authors Mike Whitney, and you'll see they'll find all your work. But that's one of the things that was so shocking to me about what you had been writing a week or so before this happened, which is, that the entire inflation in the stock market and the entire fact that the economy seems, well, at least Trump can claim the economy is doing well, has to do with the Fed pumping trillions of dollars, far more than the GDP of the country, into the markets. So there's no way. I mean, there are loans here that cannot and could not ever be paid.
Exactly.
So, they're not going to be paid. Yeah.
So let me just point out two little things, okay?
Mm-hmm.
Stock buybacks. Last year alone, okay, stock buybacks combined $806 billion in buybacks.
Wow.
Okay? And of that, 30% of all corporate debt, so all corporate bonds that were sold, were used to purchase their own stock. So here, say Joe Blow wants to start a company, okay? And he decides to issue bonds. So he's basically issuing an IOU. Mm-hmm. So I go to you and I say, buy a bond in my company. You say, well, I like Mike. I think he'll make a good product, and he has some, gusto. Maybe I think he'll be a good salesman. He'll push that thing. And what I do as soon as I get the money from you, I stick 80% of it in my pocket, buy myself a new Lincoln convertible or something. You think that's dishonest, but essentially that's what these corporations are doing with their corporate debt. They have no intention of developing product, of R&D, of factories or anything. They're borrowing this money so they can fatten the bottom line and increase executive compensation. I feel personally that's dishonest and that there should be regulations against that. I feel like stock buybacks, jacking the price of your own stock by buying back your own stock, which was illegal up until Reagan's era. That too is stock manipulation. That should be illegal, but it's not. So we have this big, overbloated, fake pseudo market with inflated values. And what we're going to find is that as the market begins to plunge, that these people can't roll over their debt, which is going to push the prices down even further, just like last time. And I honestly think that by tomorrow, the Fed is going to issue a statement because the situation is accelerating so fast that they're going to have to do something to stop the bleeding. And it might. I could see a small relief rally coming out of this, but it doesn't change the fundamentals. It doesn't change what's going on. And unfortunately for them, it doesn't change the outlook for coronavirus, which, remember, it hasn't even really seriously established itself in the United States. This is the pre-panic panic. So just imagine when schools are no longer, people aren't going to go to bus stations. People aren't going to fly. They're not going to go to train stations. There's going to be food hoarding. And yes, I know when you look at it and you say, well, only a small percentage of the people die, doesn't matter. Look at the facts. Look at what people do. You can dig in your heels and act like you're outraged. You got to sense which way the wind is blowing sometimes and just figure it out for yourself. But just don't trust the people on TV who are saying, "Oh, buy the dip." I mean, those.
Yeah. This is
always.
always.
You have to use your own critical intelligence and make your own determination of what's the best way forward.
Yep. Well, I appreciate all your insight into this, Mike. And I think we're going to have to wind up the program probably at this point. We'll probably be having you back because this does not sound like it's going to go away.
Thank you so much, Charles. I appreciate it.
Thanks again to author and analyst Mike Whitney. I'll put links to Mike's articles in the show description at widerviewradio.podbean.com. Mike continues to publish articles weekly and even more often, and that's a good way for you to keep abreast of the financial developments without having to read through all the business press. So please follow us on our Facebook page at Wider View Radio, and if you haven't done so already, subscribe to Wider View using your favorite podcast client. I'm Charles Dunaway. Thank you for listening to Wider View.